we already gave an example. I gave you an example of this discounted payback period, and this is just a recap of what we already did. So I'm just doing this for the sake of those students who missed this session, but I can promise you that it is something which is very simple. Now, we looked at a past paper question under advanced financial management in the CPA course, and the paper was done in May 2014, question number 2. And now just hold on a bit. Even if you don't have the question, do not worry, because I'm pulling my screen down and putting up that question right away. Right away there, right away. You should be able to see it in a short while. There you go. So confirm, I believe you are able to see that screen. Now, this is a 2014 paper, and it was an AFM paper, question number 2, and part A was about theory, where you are being asked, in the context of behavioral finance, explain Festinger's theory of financial cognitive dissonance. Interesting one. Huh? But today, because we are looking at discounted payback period, I want us to look at part B. We already looked at it, but I'm just reminding those students who did not join the session and missed this class, because it is very interesting. Now, I will read the question very fast and go through what we already did so that you get to understand the flow. Now, Madara Limited is considering investing in one of the 2 mutually exclusive projects. Full stop. Now, when we mention mutually exclusive projects, we already covered it as one of the types of capital budgeting projects. Now, mutually exclusive, these are projects that are competing for the resources. These are projects that serve the same purpose. When you decide to invest in one, the other one is automatically disqualified or abandoned. Now, that is what the examiner is bringing on board. I continue to read. The relevant cash flows of each of the projects are as shown in the table below. Now, you've been given cash flows. I believe you're able to see, and then the cost of capital is given as 15%. Then the cash flows are accruing at the end of the year. We have 2 projects, Project X and Project Y. I believe you're able to see them. Then we have the initial investment, the amount the investor put in each of these projects. Project X, the investor had put in 38,500. In Project Y, the investor had put in 37,000. Now, cash flows are given for the years year 1 to year number 6. Then the required part is an interesting one. We are being asked, calculate for each project the discounted payback period, and it is 6 marks. Very interesting. Huh? And then Roman number 2, you're being asked to compute modified internal rate of return. I got another 6 marks. Then the third one, profitability index. Now, because all these are discounting techniques, we're going to cover them and revise the same question using all those techniques, because they are the coverage in this part.